Right now, in boardrooms you will never see, a decision is being made that could change the value of everything you own. Not next year, not next month, this week. A new clearing system, quietly engineered by the East, is preparing to challenge a pricing structure that has stood for 50 years. And on the other side of the world, Western officials are sitting on a number, a gold valuation, so outdated, so disconnected from reality, that the moment it is corrected, trillions of dollars shift overnight. Analysts are calling it speculation. Insiders are calling it inevitable. And somewhere, between those two words, lies the truth you need to hear before the next 4 days are over, because what happens this week will not be loud. It will not make headlines right away, but by the time it does, it will already be too late to position yourself ahead of it. Stay with me, because in the next few minutes, I'm going to walk you through exactly what is converging and why serious capital is already moving. If this is your first time here, I want you to know something simple. This channel was built for people who don't have time for noise, hype, or guesswork. Just clear, calm, strategic analysis of where money is really moving in this world. Now, before we go further, I want to ask you for something. Not a favor for me, a favor for yourself. If you've ever sat at your kitchen table, going through your savings, your retirement, wondering if you're truly prepared for what's coming, then hitting that subscribe button costs you nothing. But it means you'll be standing right here with us every single week, ahead of the curve instead of behind it. Think of it as reserving your seat at the table before the room fills up. And I'd love to know, where in the world are you watching this from today? Drop your city or your country down in the comments. I read every single one, and it always reminds me just how far this conversation has traveled. Now, let's get into exactly what is happening. For decades, analysts have studied how major financial shifts begin. They rarely begin with a single event. They begin with a convergence, several quiet signals appearing in the same short window of time, each one easy to dismiss on its own, but together forming a pattern too consistent to ignore. According to market historians, this is exactly what is happening right now in the world of gold and silver. A former senior commodities strategist, once one of the most respected voices at a major Wall Street institution, recently made a statement that caught the attention of serious investors everywhere. He suggested that gold could realistically double from its current level, pushing toward $10,000 an ounce. He did not frame this as a wild guess. He framed it as the natural outcome of a much larger story, a story about currencies losing their value over time, a process often called debasement. What makes this prediction harder to dismiss is who delivered it and where. He shared it during a conversation with a financial commentator who has built one of the largest young audiences in the world of markets, reaching millions of people across social media platforms. This matters more than it might first appear. When a serious, technical forecast about gold reaches a massive audience of younger investors, it signals something important. Interest in precious metals is no longer confined to retirement age savers protecting their pensions. It is spreading into a new generation of decision makers who are beginning to ask hard questions about the financial system they were born into. The shift in attention is happening at a moment when several other forces are also lining up. Analysts who study long-term market cycles point out that gold and silver rarely move in isolation. They respond to a combination of pressures, central bank decisions, government debt levels, currency strength, and global political tension. When these pressures begin to build at the same time, history shows that the resulting price movements tend to be sharp and fast, catching unprepared investors off guard. This is why serious observers are treating the coming days differently than an ordinary news cycle. It is not simply another week of headlines. It is being described as a pressure point, a moment where multiple slow-moving developments are expected to surface all at once. Central bank leadership decisions, critical economic data releases, and shifting global trade relationships are all converging within the same narrow window of time. Historians of financial markets often note that these convergence points are rare, and when they occur, they tend to mark turning points rather than ordinary fluctuations. It would be easy to treat all of this as background noise, the kind of thing that fills financial news without ever truly affecting everyday life. But that view misunderstands how monetary systems actually function. Currency values, interest rates, and gold prices are not separate stories. They are connected pieces of a single, larger mechanism. When one piece moves significantly, the others are forced to respond, whether governments intend it or not. For the business community, the aspiring entrepreneur, and the young investor trying to build real, lasting wealth, this distinction matters enormously. Those who only watch daily price charts often miss the larger structural shifts happening underneath. Those who understand the bigger picture, who recognize convergence points before they fully arrive, are the ones positioned to make informed decisions rather than reactive ones. This is precisely why this moment deserves serious attention rather than casual observation. The signals are not isolated incidents. They are connected threads in a much larger narrative about how the world's monetary system may be preparing to shift. A respected analyst calling for dramatically higher gold prices is one thread. A massive, younger audience suddenly paying close attention is another. And as the coming analysis will show, there are still more threads, coming from central banks, from government policy, and from entire nations actively repositioning their reserves. What ties all of this together is not panic, and it is not hype. It is pattern recognition, the same discipline that has allowed serious investors throughout history to see major shifts coming before the broader public does. The question now is not whether change is occurring. The signals already confirm that it is. The real question is whether decision makers will recognize the pattern in time, or whether they will only understand its significance after the moment has already passed. That is where the next part of this analysis begins. Every major shift in the value of money tends to pass through the same narrow corridor, the decisions made by central banks. This week, that corridor has become unusually crowded. Several events that would normally be spread across separate weeks have instead landed within days of one another. And analysts who study monetary policy closely describe this clustering as rare and, in their words, deliberately significant. At the center of it sits a newly appointed central bank leader scheduled to deliver a major public address from a stage far from home. This is his first true test in front of a global audience, and markets are watching closely, not just for what he says, but for what he avoids saying. A few weeks earlier, his tone had been notably firm, the kind of language that typically signals higher interest rates for longer, language that tends to pressure gold and silver downward in the short term. Analysts describe this kind of posture as table setting, a leader establishing authority early, before softening later under political and economic reality. That reality is not subtle. The administration that placed him in this position has been remarkably open about its preference for lower interest rates. This creates a quiet tension that experienced market historians recognize immediately. A central bank leader publicly projecting independence and firmness, while privately operating under pressure to eventually move in a very different direction. History shows that when this tension exists, it rarely resolves quietly. It tends to resolve through gradual policy reversals. Those reversals are almost always followed by renewed strength in precious metals. Layered on top of this is a second major event, a closely watched labor market report. On the surface, a jobs report might seem disconnected from the price of gold. In practice, it is one of the most influential pieces of data in the entire financial system. A stronger than expected report can convince central bankers to hold interest rates higher, applying downward pressure on metals. A weaker report does the opposite, often becoming the very justification policymakers need to begin cutting rates. Some economists have grown openly skeptical of how these figures are calculated, noting that headline numbers do not always reflect the deeper condition of the labor market. Whether or not that skepticism is fully justified, the market's reaction to the headline number itself is what moves prices in the short term, regardless of the deeper truth behind the data. While these two events dominate attention, a quieter but equally telling shift has been happening beneath the surface. Recent data showed that exchange-traded funds tracking gold experienced outflows last week, the kind of headline that typically suggests fading investor interest. Yet, at the very same time, silver-focused funds recorded net inflows. This divergence is significant. It suggests that while some short-term capital is stepping back from gold, a different type of investor, often more value-focused, has begun viewing silver in its current price range as an opportunity rather than a risk. Analysts often describe this kind of quiet accumulation as more meaningful than headline price swings because it reflects long-term positioning rather than short-term reaction. Tying much of this together is the US dollar index, a measurement that compares the dollar's strength against a basket of other major currencies. Over recent months, this index has been trending upward, and on the surface, that strength has weighed on gold and silver prices. But experienced analysts caution against reading too much into this single metric. The dollar is only being measured against a handful of other paper currencies, all of which face their own long-term challenges. A rising dollar index, in this context, does not necessarily mean strength in any absolute sense. It can simply mean the dollar is losing value more slowly than its peers. Historical data supports this caution. The index has traded at similar levels in the past during periods when silver was priced at a fraction of where it stands today, proving that this single number tells only part of the story. Taken together, these forces form what can only be described as a pressure chamber, a tightly compressed window where policy tone, economic data, capital flows, and currency strength are all interacting at once. For business leaders and investors trying to read the larger picture, the message is clear. Short-term noise will dominate headlines this week, but underneath that noise, the longer-term structural pressures favoring precious metals remain firmly intact, and in some cases are quietly strengthening. What happens next depends not only on what unfolds domestically, but on a much larger shift taking place thousands of miles away, one that may ultimately matter more than anything said on a podium this week. While Western markets remain fixated on speeches and data releases, a far more consequential development has been unfolding quietly on the other side of the world, one that receives far less attention than it deserves, despite carrying implications that could outlast every headline this week produces. A major Eastern economy is preparing to launch a new gold clearing and settlement system. On its surface, this sounds like a technical, almost bureaucratic update, the kind of news item easily buried beneath more dramatic headlines. But analysts who study global monetary architecture describe it very differently. They see it as a direct challenge to the two institutions that have controlled global gold pricing for generations, the long-standing Western exchanges that set the benchmark price the entire world follows. For the first time in decades, a credible alternative pricing hub is being built, one designed specifically to reduce dependence on Western set prices. This is not framed by analysts as an effort to make gold cheaper for buyers in that region. Quite the opposite. The widely held interpretation is that this new system exists because policymakers in that country believe current Western pricing benchmarks have been artificially suppressed for years. If that belief is accurate, then the creation of an independent pricing mechanism is not a minor technical adjustment. It is the first structural step toward a world where gold's true value is no longer dictated solely by Western paper markets. This raises an uncomfortable question for those who track global financial leadership. How does the United States respond to a rival nation positioning itself as the new authority on gold pricing and settlement? If that shift occurs unchallenged, it would mark a significant transfer of monetary influence, one with consequences extending far beyond the price of a single commodity. It would touch the credibility of currencies, the structure of global trade, and the balance of financial power itself. The data emerging from that region adds weight to this theory. Recent figures show a dramatic surge in gold imports, with the most recent month representing the largest monthly total in more than 2 years. This marks the third consecutive month where imports have remained unusually high, and when measured against the same period a year earlier, total imports for the year so far have risen by more than 70%. Analysts attribute much of this surge to strong retail demand, ordinary citizens, not just government institutions, actively accumulating physical gold. This citizen-level demand is being actively encouraged. New financial products have emerged that allow everyday savers to gradually build gold holdings over time, using small, manageable purchases rather than large upfront investments. At the same time, the country's central bank has continued adding to its official reserves for 19 consecutive months, a streak that signals long-term strategic intent rather than short-term opportunism. Independent research organizations have gone further, suggesting that actual central bank gold purchases globally during the first quarter of this year may be significantly higher than official figures indicate, some estimates suggesting more than 10 times the reported amount. Perhaps the most striking development, however, is happening inside the banking system itself. Several major banks in that region have introduced accounts that allow customers to save directly in gold rather than traditional currency. More remarkably, some of these accounts now pay interest, calculated and paid in gold rather than cash. For generations, one of the most common arguments against holding physical gold was that it produced no yield, no income, nothing but a static store of value. That argument is quietly being dismantled, one banking product at a time. Taken together, these developments paint a picture far larger than any single market event. A new pricing system, surging import data, encouraged citizen accumulation, and yield-bearing gold savings accounts all point toward the same underlying trend. A structured, long-term effort to elevate gold from a passive store of value into an active, monetized financial tool. For business leaders and investors trying to understand where global wealth is quietly repositioning itself, this Eastern realignment may ultimately prove more significant than anything unfolding in Western policy rooms this week. And, as the final piece of this analysis will show, the United States may not simply be watching this realignment from a distance. As the Eastern realignment accelerates, a parallel theory has gained traction among credible analysts in the West, one that, if accurate, would represent one of the most significant monetary decisions in modern history. The theory centers on a single question. Will the United States revalue its official gold reserves to reflect their true market price? To understand why this matters, it helps to look at the current numbers. For decades, the gold held on the government's balance sheet has been valued at a fixed historical price, a figure set so long ago that it bears almost no relationship to where gold actually trades today. Analysts who study this gap point out that simply updating this outdated number to match real market value would instantly create an enormous increase in recorded national wealth, without requiring a single ounce of new gold to be mined or purchased. Several respected voices in the precious metals industry have pointed to a cluster of unusual signals supporting this theory. One involves a gold coin issued by the official mint, priced at a level close to $20,000, far above where gold currently trades. Around the same time, unusually large volumes of options contracts have appeared in commodities markets, all betting on gold, reaching that same $20,000 level by the end of the year. Industry veterans note that they have rarely, if ever, seen official coins priced at such extreme premiums above spot price, a pattern they describe as unusual rather than coincidental. One well-known figure in the precious metals industry summarized the situation directly. These signals could be independent coincidences, or they could reflect insider awareness of something larger being prepared behind closed doors. He noted that tens of thousands of similar options contracts have been placed at strike prices between $10,000 and $20,000, representing tens of millions of dollars in premiums. Critics dismiss this as money wasted on an impossible outcome. Supporters argue the opposite, that those placing these bets may understand something the public does not yet know. It is important to note that this remains a hypothesis, not a confirmed event. No official confirmation of a revaluation has been made. Responsible analysis requires acknowledging that such a dramatic policy shift remains uncertain and speculative. However, the broader context makes the theory difficult to dismiss entirely. With a rival economic power actively building independent gold pricing infrastructure, and with senior government officials publicly emphasizing the importance of maintaining the dollar's position as the world's primary reserve currency, the strategic logic behind such a move becomes easier to understand, even without confirmation. What strengthens this picture further is historical pattern data. Independent researchers who study long-term gold cycles have shown that the recent price pullback in gold closely matches the size and duration of every major correction within previous extended bull markets dating back more than 50 years. In each of those prior instances, the correction was followed not by collapse, but by a renewed, often dramatic, upward move. Current data places this correction firmly within that same historical range, suggesting the broader upward trend remains intact regardless of whether a formal revaluation ever occurs. Whether or not the United States ultimately revalues its gold reserves, the underlying message for serious investors remains the same. Multiple independent forces, policy tension, Eastern accumulation, unusual options activity, and historical pricing patterns are all pointing in the same direction. The coming days may not provide final answers, but they are likely to provide further confirmation of a trend that disciplined observers have already identified, and that careless observers risk recognizing only after the opportunity has passed.